Hey everyone, and welcome to This Explainer. Today, we're focusing our attention on something that honestly forms the absolute backbone of a healthy business. We are talking about everyday bookkeeping habits. Now, think of it this way. QuickBooks is an incredibly powerful, high-performance airplane, but it cannot fly itself. You are the pilot. And today, we're going to get you comfortable in the cockpit so you can confidently manage the financial activity of your business.
We have to start by busting the absolute biggest beginner myth right out of the gate. Does QuickBooks do your bookkeeping automatically? Well, the answer is a resounding no way. Simply connecting your bank account to the software doesn't mean the work is magically done for you. While the software provides some truly amazing tools to help you along the way, it doesn't just automatically complete your bookkeeping on its own.
Okay, let's dive into this. Bookkeeping is the process of accurately recording, organizing, reviewing, and reconciling a business's financial activity. Notice those action words: recording, organizing, reviewing, reconciling. QuickBooks gives you the digital tools to do all this, but you must provide the brain power. You have to understand what each transaction actually represents and exactly where it belongs in your records.
So, to get you fully prepared, here is our flight plan for today. 1. The truth about bookkeeping. 2. Categorizing your cash flow. 3. Matching and managing receipts. 4. The power of reconciliation. And 5. Avoiding common beginner mistakes. All right, let's kick things off with Section 1, the truth about bookkeeping. So why are we even doing this? Because accurate bookkeeping is what actually allows you to understand your performance, prepare for tax time, and make better decisions. The core truth is that you are completely in control. The software is going to often suggest categories for you, but you've got to actively review your financial activity. I mean, you're the one who knows why a purchase was made. The software is literally just guessing. Moving right along to Section 2, categorizing your cash flow. And this brilliantly illustrates one of the most important steps in sorting your money. You should never, ever categorize an expense based solely on the vendor's name. Why? Well, say you buy something at a store like Target. The vendor name doesn't actually tell us what you bought. Did you buy printer paper for the office? Or did you get distracted in the middle aisle and buy a patio umbrella? The business purpose is what actually matters. Once you know the purpose, you assign it to the right category. Think of these as specific slots where your everyday business costs are organized. We're talking things like advertising and marketing, bank fees, insurance, rent, software subscriptions. Each expense, which is really just a cost paid to operate your business, needs to find its proper home in one of these slots.
But what about the money coming in? Here is a crucial distinction we absolutely need to make. Not every deposit is business income. On one hand, we have actual business income. This is money your business earned from selling products or providing services to customers. On the other hand, we have non-income deposits. If you put your own personal money into the business, well, that's an owner contribution. If you move money between two of your own bank accounts, that's a transfer. If you borrow money, that's a loan. None of those should be recorded as ordinary business income. Otherwise, your revenue is going to look falsely inflated.
Okay, on to Section 3, matching and managing receipts. Now that we know how to categorize our cash flow, we need to prove it actually happened. A bank statement alone really only shows that money moved from point A to point B. It doesn't tell the whole story. A receipt, though, documents exactly what was purchased, when, for how much, from whom, and most importantly, it helps verify the business purpose of the transaction. So whenever possible, you want to attach these documents directly to your transactions in QuickBooks. QuickBooks makes this super easy by allowing you to upload, scan, or email receipts, but you still have to follow a workflow. First, verify the image details. Second, review the category QuickBooks suggests. Third, match it. So the crucial point is that a downloaded transaction might already exist in your books because you previously entered it. By carefully matching the receipt to an existing transaction, you prevent creating a messy duplicate expense in your records. And finally, just add a quick note describing the business purpose if it's not obvious. All right, Section 4, the power of reconciliation.
This next step is arguably the most vital, yet probably the most frequently misunderstood thing in the entire bookkeeping process. A connected bank account is not automatically reconciled. Looking at your downloaded bank feed activity is completely different from reconciliation. The bank feed just pulls in data. Reconciliation is the formal process of comparing the transactions and the ending balance in QuickBooks against your official bank or credit card statement to ensure they match perfectly.
So why is this formal comparison so powerful? Because reconciliation acts as your ultimate safety check. It helps you uncover missing transactions, so you aren't understating your expenses. It finds duplicate transactions, so you aren't double counting. It flags incorrect amounts. It even catches hidden bank fees or interest that you just completely forgot to enter. You compare your records with the statement, investigate any differences, and you do not stop until that difference is exactly 0.
Finally, Section 5, Avoiding Common Beginner Mistakes. If you want to avoid turbulence in your financial records, you need to know what pitfalls to watch out for. Let's do some rapid-fire errors to avoid. Never just click Add on a transaction without reviewing it first. As we discussed, do not assume every single deposit is earned income. Be very careful with transfers. Moving money between your own accounts is definitely not an expense. And please, avoid mixing personal and business activity. If you take money out for personal use, that's an owner's draw, not a business expense.
Now, what's really interesting about this is that most of these errors stem from rushing or just straight up guessing. Creating duplicates, dumping everything into uncategorized buckets because you don't know where it goes, blindly accepting software suggestions without verifying them, or completely failing to reconcile your accounts monthly. Basically, these autopilot behaviors will absolutely crash your books. The absolute best way to avoid all of those mistakes is to build a regular bookkeeping routine. Don't wait until the end of the year when tax season hits and you're scrambling to remember what a purchase from 9 months ago is even for. Just follow these steps regularly. Review your downloaded transactions and research anything that is unclear. Carefully categorize or match those transactions. Upload your supporting receipts and reconcile your accounts every single month to catch errors early. So, are you ready to take the pilot seat? We've covered the absolute essentials today. You now know that accurate categorization, thorough documentation with receipts, and monthly reconciliation are entirely in your hands. The software is your incredibly capable plane, but with these everyday habits, you are now the pilot equipped to fly it. But what happens when you want to use this data to actually grow your business? Well, that's where financial reporting comes in, and that is a whole other adventure. Until then, keep learning, keep organizing, and we will catch you next time.